How do capitalists profit off of the collapse of capitalism? The 2008 recession was one of the greatest transfers of wealth in human history, but who profited off of it and how? Clearly, the working class was once again forced to foot this bill and pay for it with their blood and hard work, but if the markets are crashing, how can the financial institutions and the class that controls them be making money? Like more money than ever? How do capitalists profit off of the collapse of capitalism? Under capitalism, the means of production are privately owned and controlled. You either own things for a living or you work for the people who own you and your business. You either have something to sell or nothing to sell but yourself, your labor power, your capacity to work. But under capitalism, the right to own and control a percentage of certain companies can be bought and publicly traded on the stock market at an often hefty price. And I'm sure most of you are loosely familiar with what the stock market is and does. Capitalists take all the money they steal from the working class and then steal it from other capitalists by gambling it on the stock exchange, right? But did you know that you can sell the stock without owning it? You don't even have to own stock to trade it. This can make the price go down, and this person can make bank. Okay, so what is short selling? Imagine that you are a capitalist. Say Apple is at $200 like it is right now. You think it'll go down to $190. So you go to your broker and you say, I want to sell 100 shares of Apple to open a trade. And then they straight up give you $20,000. So your money is up $20,000 immediately, but your portfolio is short 100 shares of stock. It's called shorting the stock. You essentially owe your broker 100 shares of stock because they gave you $20,000. It's a loan that you have to pay back. You would close that position by buying back the 100 shares of stock later. So if it hits the 190 per share like you thought, you use 19,000 of that $20,000 loan to buy those 100 shares, give them back to your broker, and keep $1,000. None of this should be confused as financial advice. So we as Marxists know that labor is the source of all value, and supply and demand are mostly just background noise, which, if we're in equilibrium, would give you a better idea and understanding of the forces influencing the market. But supply and demand under capitalism are not always in equilibrium, so when demand outweighs supply, prices go up. And when supply outweighs demand, prices go down. So if you're flooding the market with massive orders to sell stock, the price is going to go down. Whether you're borrowing stock from your broker or selling stock you own, in order to sell is telling the market that the demand for shares in this stock are decreasing, which can lower the price of the stock. This is the short version of the long history of short selling. Short selling, according to Investopedia, has been around since the stock markets emerged in the Dutch Republic during the 1600s. In 1610, the Dutch market crashed, and Isaac Lemaire, a prominent merchant, was blamed because he was actively short-selling stocks. He was a major shareholder in the Dutch East India Company. Lemaire, a former member of the company's board, and his associates were accused of manipulating VOC's stocks. They attempted to drive share prices down by selling large quantities of shares on the market. The Dutch government took action and instituted a temporary ban on short selling afterwards. In 1733, naked short selling was banned after the fallout from the South Sea bubble of 1720. The difference between naked short selling and the traditional short sale is that the shares being shorted are never actually borrowed by the short seller. So this practice isn't new, and it isn't even always tolerated because of the effect it has on the market. Napoleon Bonaparte saw short selling as an obstruction to building his bourgeois dictatorship and financing his expensive predatory wars and empire building. Bonaparte didn't merely outlaw short selling, he threw short sellers in jail, lambasting the practice as unpatriotic and treasonous. Many of the bourgeoisie today still don't tolerate the practice, but it's perfectly legal in many countries still. In 1995, the Finance Ministry of Malaysia proposed caning as a punishment for short sellers. A former head of the New York Stock Exchange was once quoted describing short selling as icky and un-American. Alright, so that short selling, we're going to talk about its relationship to the Great Depression, but first we got to talk about buying stock on margin. In the decade leading up to the Great Depression, you'd have been pretty foolish to go bearish and short a stock. So it couldn't have possibly caused the Great Depression. Everyone was going bullish. But why? Margin trading. Back in them thar days, you could buy a stock for 90% off. 90% off! Imagine paying like $200 for almost 100 shares of Apple and keeping all the profit you would have made had you actually threw down $20,000. I mean, just look at this chart of the Dow Jones Industrial Average. The stock market came as close to hitting a 90-degree angle that it ever has. Fukuyama, eat your heart out. The end of history was like 1929, bro. So not long after 1929, predicted only by the Marxists, what should have been obvious to everyone happened. Capitalism began to collapse. The bears started fucking the bulls. Yeah, for capitalism to be as oppressive as it is to LGBT workers, it sure uses a lot of latently homosexual imagery. But anyway, the market began forming a textbook head and shoulders reversal pattern. There's the shoulder, there's the head, there's the shoulder, and then bam! Down, down, down it goes. Like Johnny Cash. With all your cash. When a stock reverses to the downside, this is one of the many signs that show a stock is turning in the other direction. On any timeline, daily, weekly, monthly, stock charts like to fractal out. It's really trippy. Even Bitcoin does this when it reverses. Short-term, long-term, doesn't matter. Head and shoulders. Textbook reversal pattern. When the market did finally crash on a head and shoulders reversal, this crash wasn't initiated by capitalists in bearish positions. However, capitalists who, during the crash, took bearish positions, they made literal killings from people who started throwing themselves out of windows. And this wasn't just bougie-ass bullish stock investors they made money off of. Remember, everyday working-class people could afford to trade stocks thanks to the insanely low margin. A Ford worker in Detroit could probably afford buying into some nice stocks, making $5 a day, when the Dow Jones Industrial Average is chilling around 60 to 100 bucks in the early 20s. People were literally becoming rich overnight until they weren't. And while the bears weren't to blame for the start of the collapse, the initiation of their short sales did drive prices downwards just by taking the bearish position and opening a selling trade. So they made a bad problem even worse, which was made even worse again by panicking traders who were long in the stock and actually bought it thinking it was going to go up. They start panicking when they see tons of people selling off a trade. They don't know if it's short or not. They just see selling off, selling off, selling off. They're long in the stock, so they're like, fuck, I'm losing money. They sell off too. Makes the problem even worse again. Alright, I'm sensing a lot of reformists in the audience tonight. Who here's a reformist? Get the fuck out. You should be ashamed, you fucking liberals. Anyway, we're still going to talk about reform. Shorting and margin reform. The U.S. Congress, who started getting whisperings of supposed bear raids by short sellers, finally got concerned long after the economy bottomed out. They created the SEC, the Securities Exchange Commission, and gave it authority over short-selling regulations in the Securities Exchange Act of 1934, once the recovery began. They implemented what was called the uptick rule. Investopedia says that basically means investors cannot short a stock unless the last trade was at a higher price than the previous trade. The effort was meant to slow down the momentum of a security's decline. Besides the uptick rule, margin today is 50% instead of 10% or 90% or whatever the fuck. So you have to pay 50% of the price of a stock instead of 10%. You can only get stock half off. It'd be nice if workers could get things for 50% off anyway. During the dot-com collapse in 2000, which also had a head and shoulders reversal pattern, the uptick rule made it a tiny bit harder for the bears to be in complete control. And eventually the market started to recover after the collapse. LOL, look, Bush did 9/11, this is proof. And if that joke wasn't conspiratorial enough for you, here's where things start to get pretty fucking shady. The orchestrations of the 2008 upward transfer of wealth. So we had the dot-com crash, tank, boom. There's 9/11 again. Anyway, here's the recovery, and it's making a pretty strong recovery for a while. It gets right back up to its previous highs that it made at the dot-com bubble. Then what happens? It meets resistance again. Common thing that happens. Old resistance becomes new resistance. I don't know how much more obvious it can get that a stock is about to reverse. I've only been studying candlesticks for like a month now, and it's obvious to me, but I guess everything's obvious in hindsight. But look at this. The longer-term reversal pattern is a double top, also referred to as a dial M for murder. But the right side of that M is also made up of a head and shoulders. These are clear signals. So on a bigger chart, it even forms a head and shoulders with two heads. It even forms yet another clear reversal pattern that's usually a part of the dial M. It's called the kiss goodbye, or the kiss of death. But investors with their money on the line, they sometimes let their emotions get the best of them. The kiss goodbye is actually a bearish upward move, if that makes sense. It's a bearish retracement, which signals the stock is getting ready to move down again by going up. But because it's an upward move, these longer-term investors are going, hell yeah, it's going back up! But it's really the kiss goodbye. What happens next is shady as fuck. Back to the chart. We're recovering after the dot-com crash, up, at the same exact resistance levels as the 2000 reversal, head and shoulders forms, we get the kiss goodbye, and then, so remember that uptick rule, it fills short sales at a price higher than the last price, so it gets filled on an up. So, where on this chart do you think the SEC, who created the rule to stop massive crashes, got rid of the rule? They eliminated the rule. Where did they do it? Where would you do it if you were looking to make massive amounts of money from the 401ks of the working class, from their retirement? You'd do it after this last candle if you're extremely greedy and corrupt. So, then where did the capitalists, who look out for the best interests of all of society always, where did they do it? The uptick rule gets eliminated by the SEC on July 6th, 2007, after the last candle. Then, you are looking at one of if not the most massive upward transfers of wealth in human history. The uptick rule wasn't implemented again until March of 2009, long after the quantitative easing started moving the market back up. And today it's completely neutered. In 2010, the SEC constructed an alternative uptick rule to restrict short selling from further driving down a stock price that is drop down more than 10% in one day. It has to drop more than 10% in that day before they restrict short selling on it. But you can short a stock that's already shown it's likely to drop the next day with a signal or pivot and short it the next morning long before it ever drops 10%. And how often do stocks even drop 10%? That'd be insane. Most short selling happens in the very first 30 minutes of the day when the pre-market shows that there's going to be a massive gap down. So yeah, reformism is bullshit. Reforms can get reversed at any time, and they do get reversed all the time. So, revolution, not reform. Read Rosa, you bitches. One more thing before we get out of here, we have to talk about stock options. It might be a little confusing, but I'll try and make it short and sweet and easy to understand. Shorting stock is only one way capitalists make money during crashes. It's not the only way. There's also stock options, which can be looked at like insurance on a stock. Instead of buying 100 shares of a stock, you could buy one stock option, which gives you control but not ownership over 100 shares of stock. What that means is it gives you the right to buy or sell a certain stock at a certain strike price. So, in 2008, if you thought Bank of America was in collapse, you could buy one put option in Bank of America, which gives you the right to sell 100 shares of Bank of America at whatever strike price the option represents. So, say it's 2008, and you're sitting at the kiss of death. You could buy a put option with a strike price that says you have the right to sell 100 Bank of America shares for $55. Then, as Bank of America falls all the way to $2, people who are long 100 shares of Bank of America would pound at your door, begging you to sell them the right to sell their $2 bills for $50 each, and they're going to pay thousands and thousands of dollars for it, while you paid maybe $250, $300. So yeah, that's about it. I just kind of found this stuff fascinating, and there's been a lot of fear lately that we're heading for another crash, and honestly, if you do look at the overall broad markets, you can kind of notice a similar pattern to the Great Depression if you incorporate the two recessions before the Great Depression as well as our two last recessions, the dot-com and the '08 crash. We're kind of forming that same M pattern and then huge mountainous peak, and that means the next upcoming crash could knock us even lower than did the '08 recession, and that would definitely plunge the world into a lot of chaos and turmoil and possibly new imperialist wars. We're only a couple weeks into 2020, and it looks like World War III could be pretty fucking close by. Yeah. Oh yeah, so comment, and subscribe. This is my first my own research and writing, so let me know if you dug this style and shit. We might do more of this instead of just reading WSWS articles, because that's boring. This is more fun, so yeah. Oh man, yeah, take it easy, comrades.